Good day, fellow investors. Value Investing Quadrant update for March will touch on the key businesses that are, let's say, in a risk and reward buy range, and especially will focus on Samsung, JDE Peets, Nutrien that have recently released their earnings. But let's start immediately with Petrobras. If we look at the situation here, since the first initial analysis, the dividend yield is still huge, and as time goes by, people are rewarded with a 20% yield, which is something crazy and insane. And if oil prices remain in these levels, Petrobras will just continue to pay that dividend, everything great, reinvest. I think it's maybe a little bit lower, but they target 13% going forward, which is high. However, if oil prices crash for whatever reason, then the dividend will be cut and this will look very ugly. That is why Petrobras is here on the risk-reward quadrant, 13–15% yield, but the risk is high. Perhaps I should bring it a little bit lower even to the really high risk on the oil cycle. Next we have ASML, the Dutch company that, let's say, is a little bit stable. Recently we have discussed it this month in a video how all else equal, if they keep on growing as they plan, it is unlikely that you will lose money in the next 5 years, but it can easily double as it has been higher, so the risk and reward on the situation is pretty positive, all else equal, of course. All the links to the discussed videos, the specific analysis, will be in the link in the description below, so feel free to check that on the stocks you are interested to know more about and dig deeper. Another situation that we recently discussed is the chemicals. So this is the video where we discussed how are the 7% yields and potential 2x in the cycle. If the cycle rebounds, then we have high yields and high upside. However, I have put it here around 7–8% because now, yes, the earnings yield and everything is 10% if you look at an average cycle. However, I know that in a real cycle downturn, the average free cash flow yield on these companies is 20%. That's why it is pretty risky to buy now the upside. Yes, the upside and the yields are there, but there can still be minus 50% downside on that, let's say, risk of a severe cycle downturn, global recession, things like that. So that's something you have to see if you want to start a position now and then double down when the right time comes. Verizon, interest rates are going a little bit lower. What's going on with Verizon? Well, stable. It already jumped a little bit here, but it is a little bit on the positive side. The dividend yield is not 7% anymore, it's 6.2, or what was it, 6.7 a while ago. So I might have to just put it a little bit here on the lower return, because as the stock price goes a little bit up, a little bit down goes Verizon. That's just how it is. Maybe also a little bit riskier because of the huge debt if interest rates change. Now, a stock that I want to dig deeper is JDE Peets, Dutch company, and you can see here it with a good 8% likely return, food, coffee prices, coffee distributor, so looks okay. You can see here there is a dividend yield. They have now announced also buyback during their results, so everything looked good. Coffee is transfer your price to the consumer, so if coffee prices go up, all we have to do is pay more for the coffee, and the coffee producers and sellers make their margin perhaps even a little bit higher on higher prices. Depends on how competitive the environment is for them among producers. Because I don't think you will renounce your coffee while watching these videos. That's a combination you can't resist, right? So the brands there, they're not the Starbuckses, but they are very used, very stable. There is organic growth, so everything goes well. There is a little bit of leverage, which is the key risk there, I think, and you'll see in a moment now. But all else equal, Earnings per share adjusted, P ratio of 10, free cash flows going well. They have done this huge acquisition, but it didn't increase that much the debt as the free cash flow was there already. Net leverage improving a little bit. I think the target was 2.5, and given that the target was 2.5, already they have announced buybacks and a little bit increased the dividend. Now, let me show you a chart that you must promise that it will not reach Donald Trump. Because if Donald Trump sees this, then he'll get pissed at Europe. Because this is the competitive advantage that is crazy for European companies, and these companies haven't even taken advantage of this over the last 15 years. I don't know what would Europe look like if this would be a normal American company with 5 to 6% debt. That would be crazy, and that would change the complete structure of everything. This is the key also risk for me when I'm looking at this. This is rigged, this is European Union, this is European Central Bank. I don't know how they pull it, but yes, if you have no cost of debt, you can go around the world acquiring other businesses, JDE Peets and things like that in the States, and then you should make money on it, especially as it is in euros. The euro is weakening, so that's the competitive advantage that is insane. And if Trump understands this or knows this info, then everything that he is saying will look small to this big factor. Of course, apart from joking a little bit, green coffee prices are going up, so the outlook is, let's say, stable going forward. They still think they'll reach 1 billion in cash flows, capital allocation. As things are going well and there is the optimal leverage target, they have introduced buybacks. On a 10 billion, that's 2.5%, 4% dividend yield, that's already 6-7%, plus some growth, that's the 10, 8, 9, 10% return you have there. Dividend yield increased, so if they keep on doing that, great. Intention to initiate share buyback, all great. If they keep on doing that, yes, it will awaken the senses of the market, and the stock might even continue to go higher. Some analysts have it now at a price target ratio of 30. Of course, there have been some concerns in the Netherlands, in Germany. Some retailers have said they will not put any more of JDEPEETS coffee like Jumbo and some in Germany because they are increasing the prices too much. But then we go to the discussion there, and they already say that yes, it is something that's going on, but that's the normal process of negotiation, and that usually coffee is a pass-through business where the prices need to be transferred to customers, and they have already concluded 90% of their negotiations for this year. Thus, just 10% of what is left is then questionable, and we'll see how that goes going forward. The brands are strong, let's say, so it will be different. Maybe people will not go to Jumbo but to Albert Heijn, and that's a different story there. So I keep it here. There is perhaps a little bit more risk. I should bring it a little bit here because of the debt, but until the debt cost is just 1.3%, this is very cheap. Same basket here, Nutrien. There is this cycle. Now prices, we'll see fertilizer prices have increased a little bit. Nutrien is having a stable dividend. Don't look at P ratios with these commodity producers. They have their highlights, 5 billion of EBITDA, the standard 2.3 billion of capex. Compared to the market cap, this is in Canadian dollars, what's that, 27 billion. You have 2.5 billion, that's at 9-10% yield, plus the global growth. We are there at that point in the cycle where we can expect 10% from the safe and reliable retail operations, good balance sheet, consistent shareholder returns already there, and then also they are always investing in something. And you can see here how food prices, yes, did boom. Now we are in a downturn, but we are in a higher place than we had, let's say, 4 or 5 years ago. Therefore, that's a positive. Perhaps there will also be some limited capacity and some tightness in 2025. That depends also on Russia and the situation there. But in general, we can see here already a spike in prices, and the stock immediately follows there. But that is always the cycle with these fertilizers, and you never know when will this ammonia come back to the market. With these things, the supply is there, so it's not that anything would change there because it's still hitting the market, likely going to Asia. Phosphate shipments, also you can see the long-term growth trend depending on the price, especially this is India is growing, so we have to think of these businesses from a global perspective, and I'm keeping it here. In a really severe downturn, then this can go to 15% yields with much less risk, but we are still now, let's say, I have it as a mid-portfolio position in my diversified portfolio, as I do have Archer Daniel Midland a little bit higher position in the diversified portfolio. And speaking of ADM, still stable there. You can check the full detailed analysis video there for this company that has been increasing its dividend for the past 51 years. Further, another thing that I might focus a little bit here is Samsung. This will report in March, so that will be in the next video for discussion. And Samsung is trading now at a P ratio of 11. It is exposed to the long-term AI chips, handphones, smartphones. So you can see that just based on the cycle, this is now a cheap opportunity to, let's say, put this in your portfolio if you like the business. Also traded in London, so you can also find it there in US dollars. If we go to the discussion, this is something that I want to touch here on Samsung. You see that the liabilities are minimal compared to the equity. You're buying this at the price to book value, which is the time to buy these cyclical semiconductor companies, especially companies like Samsung. So that is also something that gives it, let's say, a margin of safety where no matter what, the cycle can be ugly still, and they expect the cycle to continue. Weakness in the semiconductor business in Q1, maybe Q2. But if they can get through their technological issues in foundry that they have, and that this should then boom. And the market is always waiting for it to already happen. It's very hard for people to invest before it happens, but that's exactly why the price is so low. Maybe tariffs, maybe this, but despite that, it looks like a very, very interesting risk and reward opportunity. Now, I have just one issue here. This, I know, these companies, I have been following them for almost a decade. I know them really well. I understand the cycle, I understand the risk, I understand what can happen, the strategy, everything. So you can wake me up at 5 o'clock in the morning, I can tell you the story there. Samsung, I have just started looking at it a few months ago. Perhaps I need to now write a deep dive for my platform to understand it better. It takes time, and perhaps in the next few months, if the price is still there, then I might, if I get the point of the story. For now, I'm just, let's say, 50% knowing all I need to know to understand how would Samsung fit a diversified portfolio. All the indications are that it is already very interesting, and that's why I have put it here. And then over time, I might also make a deep dive video like I made on the other things. This might get more interesting. If there is something I don't know on Samsung, please share it in the comments below. So we have some interesting ideas, some interesting things to follow. See how it fits your portfolio. Of course, the premium version of this quadrant is on my research platform. Thanks for watching. I'll see you in the next video.